Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our February monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. It was great seeing many of you at our forum just a couple of weeks ago. We gathered at Perry's and had about 100 clients there, so it was great seeing many of you there. Hopefully, we'll see many more of you in April at our next quarterly investment forum. This is one of the questions we asked at our recent forum, a term you may have not heard of until the weekend between January 24th and 27th. DeepSeek, in summary, is a Chinese AI startup that claimed to do what many of the other larger AI companies have done with a fraction of the cost, and that led to NVIDIA as the most notable example, losing almost $600 billion in market cap on Monday, January 27th. This was some of the other affected stocks, with NVIDIA kind of catching most of the headlines. What's interesting about this is since January 27th and the big sell-off, NVIDIA is now back to near where it was before that period of time. But DeepSeek is an example of kind of what's always beneath the market that could spook the markets. Last year was the yen carry trade that hit the markets in the summer. So those things we're carefully following and can always spook markets over a short period of time. All this said, January was a positive month for stocks. And with January's positive, going back to 1926, you end the year higher 80% of the time. So that's 49 out of 61 years. We're also in a bull market that's now in its 26th month, and a median bull market going back to 1926 that's 55 months. So just because we've rallied and we're near all-time highs doesn't mean that the bull market can't go further. It doesn't mean it will. But again, we're about halfway through the median bull market going back to 1926. We're still in a period of time with a lot of concentration in terms of the top 7 or Mag 7 stocks as they're referred. The average weighting of those 7 stocks for the year ending 2024 was 30% of the S&P 500, and it had accounted for 54% of the S&P 500 return in 2024. So that's still something that we're following out. Whether the market broadens out to include other parts of the market is something that we're carefully following. And this just is a different indication of the same thing, which is the top 7 stocks on average have been 16.5%. The number we just looked at said that that was over 30. So a lot of concentration that's beyond average. And even if we go back to the tech bubble before it burst in 2000, this top 7 companies, which by the way included GE, Oracle, Pfizer, Exxon at the time, was only 20% of the weighting of the S&P 500. So the top-heavy nature of the S&P 500 is something we're paying attention to. Jobs report was fine for January. It wasn't too hot, wasn't too cold. 140,000 jobs added. The most recent inflation print, while it wasn't a big surprise, just kind of shows that headline and core at about 3% is kind of stubbornly kind of stuck there without any kind of short-term indication of moving towards the Fed's 2% inflation target. And kind of what that means is the likelihood of rates going down, meaning the Fed cutting rates. This is kind of where we've been, 22, 23. We've started the rate cutting cycle, 100 basis points of cuts in 2024. And it looks like the odds are a couple of 25 basis points cuts for the entirety of 2025, given market data as we know it today. The economy, this is kind of where we close Q4 and what's projected for 2025. So the expectation is the market or the economy, while slowing down, continues to grow into 2025. And these are kind of the broad indicators of a recession or not. So the red indicating, some concern, and the green pointing kind of against a recession. So more indicators are still pointing towards a market that's growing, albeit slowing down. Some signs of worry, though, are debt, meaning this is household debt service ratio that says 11% of a household income is spent towards just servicing debt, and that's on the climb. You also have delinquencies that are picking up Q3 of 2024 in auto and credit cards, about a 9% delinquency. So since the consumer drives 70% of the economy in the US, this is worth paying attention to. And the reason we talk about recession, among other things, is it has a big impact after the Fed start cutting rates, which they did in September of 2024, how markets do represented by stocks and bonds. Whether we go through a recession or not is relevant. So in a no recession environment, after the Fed starts cutting rates, within 12 months, you see stocks and bonds both do well. And again, keep in mind, our benchmark for that is the Fed cut for the first time in September of 2024. If we do get a Fed cut and a recession within 12 months, that goes the opposite way for stocks and is still supportive of bonds. Debt levels remain a big concern. We're running 120% budget deficits, 36 plus trillion in debt, and some data points that kind of support that. The most recent budget deficit, just under 2 trillion, which is created based on these two things. Despite record receipts of just under 5 trillion, we're spending almost 7. So this remains a key issue. And interest expense, so just expense on servicing the debt, is now greater than we're paying for defense. So this is something that we're keeping a close eye on, and is a risk factor in the market. There's some indication that we're now 3 months past the election, that there was some kind of pent-up business activity that could be a tailwind for economic growth and markets going forward. Just one data point is about 2/3 of CEOs said that they were delaying key investments until after the election. So we'll see if that kind of plays out in the data, but it's worth paying attention to. And now we know, at least until the midterms, what the composition in DC is going to look like. It only happened 10% of the time that Republicans had control of the White House, House, and Senate. In that 10% of the time, the economy grew at an average rate of 3, and the markets were up. The S&P price return about 13. Again, this will hold at least until the midterm. So now that we have real data, the 10% of the time that the reality that we're in happened, this is the result in the economy and financial markets. We're also in kind of the mid or odd year between the presidential election and the midterms. On average, that's good for stocks, with the most recent example being 2023, and stocks were up about 26%, although really all of that was November and December of that year. As it relates to kind of cash on the sidelines, this is another kind of interesting indicator. Just under 7 trillion as we close 2024. In other periods of time where there's been peak money market rates, you typically see good results over 3-year periods in stocks. Over this time frame, before or the last time there was peak money market, these last 3 periods of time have been very supportive of stocks. And then just really zooming out to the almost 100 years going back to 1926, what this shows is, I know this is a busy slide, but 73 of those 99 years have been up. 26 down, the average up year is 21, the average down year is -13. All of these 26 and all of these average returns are painful to go through, but it just does indicate that regardless of what's going on in the world, the time and the momentum is both on the side of the markets being up more than they're down. So some headwinds and tailwinds to briefly talk about. So headwinds, so things to be concerned about. Valuations are pretty rich. The breadth of the market is still pretty narrow. Recession is still possible. Inflation, while it's at 3, so it's down from peak, is still stubbornly above where the Fed's target is, which leads to higher interest rates and the Fed cutting less in 2025 than the markets want. Geopolitical risk, debt levels remain. Again, we're running $2 trillion deficits and a cumulative debt of over 36 trillion. DeepSeek is an example of just something that could spook the markets at any time. And earnings at some point could disappoint. Earnings have been pretty supportive in recent years, but this could always be a headwind. Tailwinds in terms of the things that are supportive of markets. The Fed did start cutting rates in September of 2024. That's anticipated to continue in 2025. There is a broadening out of markets. The election risk is now over. Geopolitical, to the extent there's any improvement, whether it's the Middle East or in Europe, would be a tailwind in the market. Transformative AI, things like Stargate, and earnings continue to be supportive. So none of this is a replacement of contacting us directly to discuss how all of these things impact you. So please reach out to us if you have any questions about anything. We're here to serve you. So with that in mind, we'll close, wishing our Houston clients and clients throughout the country a great February. For our clients in Houston, I hope you're staying warm. And until we see you again, be well and take care.